Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. So it seems like the SP 500 rally that we've had since October is turning around, losing momentum. Even though we did have a break above the trend line right here, it seems that the price is coming back down to retest these key moving averages at the 50 and 200-day moving average, something which shouldn't really be much of a surprise to us. The yield curve, the signal that we're getting from the bond market, is the most deeply inverted right now since the 1980s, a period in financial market history that included some of the worst bear markets that we've seen. In this video, I'm going to show you why the fact that the yield curve is deeply inverted does actually signal the fact that things are going to be worse looking forward, that the deeper the yield curve inversion, the worse the economic outlook in the future. I'm going to show you what that means for the stock market and how to go about positioning for this type of environment. Don't forget to smash the like button if you enjoy this video, and if you're new here, don't forget to smash the subscribe button. Now, without further ado, let's get right into it. Now, other than the fact that unemployment systematically rises in the year that follows the yield curve inversion, which this time around happened in August of 2022, we can expect unemployment systematically rises after that. Why does that work? Because the yield curve, which is basically long-term rates minus short-term rates, the 10-year minus the 1-year yield, for example, this is basically the bond market telling you that short-term rates are much too high for the strength of the economy. So this is the bond market's way of pricing in the fact that there's economic weakness ahead and that the Fed that's been raising rates and causing this yield curve inversion, they're soon going to run into a wall as we head into a recession, as the unemployment rate rises, and they're going to have to loosen policy, which is what you call the steepening of the yield curve. Now, what's interesting is that we actually found that deeper inversions is correlated to weaker economic activity. You can see here, this is a chart that basically tracks the depth of the yield curve inversions, how low do these inversions go, and PMIs, so basically economic activity. And you can see the deeper the inversion, the more PMIs go lower. 1978, 1980, seeing the worst drawdowns in PMIs that you can indeed see right here. Worst drawdown on PMI 1975. 1980 right here as well, and it was pretty bad in 1970. We can expect probably something along those lines this time around. So we probably have not seen PMIs bottom just yet. And when PMIs are low, that typically means the market is moving down. You can see PMIs low here. Market is moving down because economic activity is weak. PMI is low, the market moving down, earnings are contracting in this type of environment. Again, 2015, PMI is low, sideways period of consolidation. And then, of course, 2020 right here, a huge period of market volatility. And you can see this chart proves it out as well. PMIs following yield curve inversions, you can see systematically, except for 2006, actually, very interesting that the recession came a lot later in 2008. But you can see on this chart, 2006 is actually quite an interesting exception because in vast majority of cases, PMIs move down much lower in the 12 months after the yield curve inversion. So that's where we currently are. Economic activity is set to continue declining. And I'm going to show you in just a second where we could potentially see a bottom, what type of signal we can potentially use to find a bottom, to know when we can get more confident about a bottom being in this market. But before I do continue this video, I want to make an announcement. Of course, don't forget to smash the like button. It means so much. It helps out the channel massively. But I also have some exciting news to share with you today. As you know, we are committed to helping individual investors be successful in the stock market, to trade the macro environment as profitably as possible. And we're trying to provide that service to as many people as possible. And that is why for the next 24 hours, we are offering a special discount for the viewers of this video. This means you're going to get access to our entire service, our model portfolio, our tactical updates, our research, our tactical watch list that covers the key levels, the key developments multiple times a week, all for a more affordable price. So don't wait till it expires. Take advantage of this offer and join our community of successful investors today at gameoftrades.net. Now, something else I wanted to show you in this video was leading economic indicators that are dropping like a stone here. You can see this is leading economic indicators against the real GDP in red. That's still in the growth zone, so above zero. And it's currently telling us that we're most likely going to see GDP at the very least dip into negative territory. So further economic weakness ahead. But what I also wanted to show you in this video was this chart right here that shows the spread between leading economic indicators and coincident economic indicators. So basically the probability of a recession that rises, that blue area right here, you can see that. And what's interesting is that they track this against initial jobless claims, so the unemployment rate basically, and it's a very good signal that unemployment is going to rise. So just another confirmation of this chart right here that shows the unemployment rate typically begins to rise in the 10 months following an inversion. Now what's interesting if we add the unemployment rate on this chart is that we've never seen a bear market bottom before the unemployment rate begins to rise. So I'm going to show you a few examples here. 1970, we've got 1974 right here. 1982 was a pretty vicious bear market during a very high inflation environment. 1990 bear market bottom right here. 2009 bear market bottom. And we're going to skip 1987. And we're going to skip COVID because these were really flash crashes instead of true bear markets. So you can see where all of these bottoms occur. They systematically occur, whether you look at more recently the deflationary episodes of 2000 and 2009, or you look at the inflationary 70s, all of them systematically bottom as the unemployment rate is rising. Unemployment rate rising. Same thing in 1990. In 2003, it was peaking. In 2009, it was peaking. The only time you did see a bottom was actually 1966, but the unemployment rate didn't really rise here. So you could argue that this was a soft landing. You just had some weakness in the labor market, but it didn't trigger an actual recession. So that perhaps is where we currently are. Perhaps we're in another 1966 scenario. Although here, if we look at the yield curve, it was a lot less inverted. Yield curve is currently a lot more inverted right now. And inflation was only at around 3% back here, meaning that the Fed was able to loosen monetary policy a lot quicker and make that soft landing scenario happen, which seems less and less likely today. So what does that actually mean for the short term on the S&P? If you watch the videos that we posted in the beginning of February, we did signal many times the unattractive risk reward for being in the market. Now you could argue from a pure objective technical standpoint, we're revisiting some very important support levels where you are going to see some buyers come in. 50-day moving average, 200-day moving average. The problem I see here is that we're coming back to this level in a very rapid way, which increases the odds of just slicing through them. So we'll be watching this, but if we start to break through these levels, most notably 3,900 points, that opens the door for really resuming the bear market and moving a lot lower very quickly as we get into that final stage of the bear market where you have a lot of panic, you have a lot of volatility. Things can get ugly very quickly in that type of environment. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash the like button and subscribe to our channel if you have not already. Now, in the meantime, I wish you good luck on your trading and see you next time.